this lesson is going to be focused a bit more on the macro side over the charts. There are going to be some cool lessons to pick up. Um, just wanted to go, as always, just an overview of what's been happening in markets land, sort of, if you know, um, just your 30,000 foot view, your like your briefing, your weekly briefing. So um, we've been risk on, okay, and you know, we thought that the last Fed presser was a game changer, was a bullish game changer, in terms of how the markets responded and how the Fed responded. And we also thought that this week, I also thought that this week was even further bullish confirmation of how the Fed responded to how the market responded to how the Fed responded. I know that that sounds like a kind of a huge jumble, but basically, um, Powell spoke on Tuesday, and notably, he failed to push back against the dovish money flows across that we've been seeing. So I think this puts the market in a very data dependent predicament, whereas before it was Fed dependent, Fed expectation dependent. And so that I think throughout your trading journey, you're gonna see a lot of news events. I mean, literally, there's news coming out every day, right? And it can swing the market, it can cause sell-offs, right? But that doesn't mean that the narrative's changed, right? So we're gonna go over a few news events that happened, but they weren't bearish game changers. But the last Fed press conference, that was a game changer, right? And so your ability to identify these moments when things are game changer are crucial um, in your success as a trader. So just wanted to reiterate. So we broke out of this downtrend line. So the we've we've crossed this resistance zone. Now what the markets did here, classic breakout and retest. So we broke through the resistance, okay, at around 4,100, and that was the level we were eyeing. So um and then we retested it as support. And this is the crucial moment. Um and we're using it as support. So this is a huge signal. Yesterday we had a down day, whatever, but look, this is an inside day. We closed well within the previous day's range. We didn't make any new lows. I would be striking a bit more of a wait and see tone, right? But if this was different, but I think this is reasonably strong. I even think this is sort of an ascending triangle-ish pattern. I think this momentum will carry through. And as we've been saying since the presser, and even a bit before, and we're starting to get a bit more risk on, the presser gave us real conviction. And I think until March, April, the markets are cleared to rally. And I'm eyeing this 4,300 level. Now, for reasons I'll explain, I think the market will be a little bit overvalued at 4,300. I don't expect us to punch in new highs until a few things happen, and we'll go over that. But this is very much one of those travel zones where you just want to, you stick to your positions, maybe you tighten your stops, and then you enjoy the ride. Okay. So we're retesting this as support, which is what happens on breakouts. That's really the real confirmation. Looking into yields. So this is global yields today, from Spain to Italy, Canada, all across the world. Yields are falling by quite substantial margin here. These are 2-3% moves. If you look at 10-year rates, this looks very weak. Um, this looks like a chart that's ready to roll over, right? So, um, just doesn't looks like there's a bit of an air pocket there. Yields retest lows of 3.3. And of course, um, if you're just joining us, that's significant because lower yields point to higher stock prices, at least in this predicament, the way we are right now. Okay. Um, Even more so now that we're entering a data dependent. So when I pull up the market multiples table, I'm no longer looking at Fed action or Fed expectation or expected. We're looking more at market based, right? Because that's gonna and yields are the biggest market based indicator. Um, we had a really strong 10-year note auction this week. Pretty weak 3-year auction, which actually kind of made the market sell off a bit, I think, on Tuesday. But um, you know, 10 years way more widely traded, had all the eyes on it, and the 10-year auction was very strong. And that's good. That's a good sign for risk. And when I know I've said this before, but I'll keep repeating in case you're new. What I mean by a strong 10-year auction, the government needs to pay for stuff, right? So they have to auction and roll over debt every once in a while. And they set a price based in yields on this debt. And they say, we're going to auction this 10-year debt at 3.5%. And then the market sort of bids on it. Okay. Sort of like a whitelist and a mint list product. It's just an open bid. And then if the yield comes in higher than what the government set it at, that's bad because the market is basically saying, oh, you only want to give me 3.5%? No, I need 3.7. Okay, that's pretty drastic. That will never happen, but it's usually a few basis points, but that's the idea. But in this case, the government said, hey, can I have 3.5%? And the market was bidding so much that it actually came in a bit lower than that. Or about in line or a bit lower. I can't remember. And that's good news because if the market, again, bond traders are smarter traders, right? They have more data. It's not retail, right? It's purely your smartest participants. So if these guys or girls were afraid of inflation, do you really think, they wouldn't be bidding US government debt to lower yields, right? Um, they would be, they would be saying, screw your debt, inflation's going to come higher. I need a higher rate. Okay. So kind of went on a tangent. All that to say, so I do think yields are going to head lower. I think this chart pattern is conducive to an air pocket lower. Our target is 3.3, 3.4, which is another 20 basis points move, which is actually huge. It's actually a pretty big move in fixed income. 20 basis points lower. I think stocks look strong. We've retested support. We're holding support. How do we know we're holding support? Well, a few indicators. Again, this is just on a probability basis, right? We are inside the previous day's range. We're not punching in new lows. We've responded to support. So we've broken resistance, retested as support. I think we go in to trade into this range. Okay. So this is the technicals. Okay. So where we are. I'm going to speak now on the macro and the fundamental, and we're going to pull out our market multiples table and basically answer a few questions. What is the market pricing in at this level? Is it extreme euphoria? Is it fairly valued? Right? And if we get to 4,300, is that going to be fairly valued or overvalued? Sort of what do we need to see? And we'll go through that sort of logic. But before we get into that, wait, did you have any thoughts of sort of what you've been seeing, or any comments you wanted to make sort of before we get into the more macro side?
No, no, nothing new or additional from me. Just keep going.
Yeah, okay. Right. So pulling up here. Okay. So we're gonna go through our market multiples table, but also want to just go over this. So actually, no. Before gotta give the overview of sort of what's been happening. I'll quickly. I think this is kind of important. So again, as I said in the beginning, Powell spoke Tuesday. He failed to push back against the dovish price action we've been seeing, risk on price action, and that's pretty atypical of Powell. Uh, if you followed the Fed in the past, anytime the market has made a sizable rally, especially into resistance, these three areas right here, um, he's pushed back pretty severely, and that's caused markets to sell off. And now we're seeing a bit of a change in tone. Okay. Again, my base case thesis, as long as that is not too hot or too cold, the rally continues to March, April. Okay. We had comments from Fed Governor Williams, who said he wants a terminal rate above 5%. That actually caused stocks to trade lower. But again, stocks kind of brushed it off. And remember that markets are proving to be more data dependent. It's less about the Fed speak now, and it's more about what data is pricing in. And so that's why I wanted to highlight that, because that's a pretty significant change. Okay. Um, if yeah, so if that kind of caused this pullback, but that those sort of news were sort of cover for the pullback or cover for the selling. Um, this pullback would have happened anyways on a technical basis. The most important thing is that we're holding. Okay. Um, so let's go to the part here. So so I think there's a huge debate between soft landing and hard landing, right? But there's also a new sort of possibility, and that's no landing at all, right? And the no landing scenario kind of just prolongs the soft landing, hard landing debate. And the no landing scenario is that inflation keeps declining, but economic data stays incredibly resilient, and it kind of emboldens the Fed to potentially be on a more aggressive rate hiking path. Um, Now, this is pull here. So the fact that um, let's start filling in this table. Actually, I won't get to that part. Sorry. Um, so if we have yeah, I'm sorry. There's a part that I think it's too early to introduce this. So I'm going to start to fill this in. So if we look, so inflation, disinflate, this is pretty simple. The current situation we have, let's fill it in. So disinflation is continuing. Okay. Uh, Labor market incredibly tight still. The this is where the no landing, you know, plays in. We economic growth is still incredibly resilient, and that prolongs the Fed's rate hike path, which could be bearish for stocks. Now, why is this an actual risk? Because, okay, this is what I was debating bringing up. There's this relationship in economics called the Phillips curve. Okay, the Phillips curve basically says as the labor market is hot, inflation should be hot, and if the labor market is weak, inflation should be weak. Okay. Now, over time, it's been debated whether this Phillips curve relationship actually actually works. Okay, there's actually indications to say that this Phillips curve relationship is broken. Okay, so it's precisely, but it's still followed. So it's precisely the fact that it's broken that leads me to worry that if economic growth and labor market continues to be incredibly strong, okay, uh, the Fed might actually respond to it while disinflation goes nowhere. Okay. And I'm sort of going to unpack that a bit more. So if hey, can you guys hear me? Yeah. Okay.
Yeah, we can hear you.
Yeah, perfect. Sorry. So Fed expectations for the current situation, what the current situation's pricing in. And I say market based, between 4.8 and 5 and a dozen percent. We that I think anything above that gets into a bit more hawkish territory. 2023 EPS is still at 225. Okay. So now the multiple. What is the current multiple? Uh, we're currently between 17, 18 times. Okay. So I think this is pretty justifiable on just on the fact that we've had a bit more clarity from the Fed. Okay. The fact that Powell didn't hint that he would take rates above 5.125%, as he has done in the past. He didn't explicitly say that. That's a signal in itself. Okay. So that warrants historically just a 17, 18 time multiple. Okay. And if you look at that, that implies that the S&P range should be between 3,800 and around 4,100. Now, that tells us that we're a bit overvalued and to slightly fair valued, okay? And I actually think that's fair, okay? Uh I would say although I am bullish and I will trade the travel because even if so let's say according to our model, quote unquote, fair value is at 4,100, okay? That doesn't mean that the market is going to stop on a dime at 4,100, right? Usually markets can trade through the levels and be a bit more overvalued. Um, I think, I think, I think our view that markets continue to rally is based a bit off that. We start pricing in a bit of our more soft landing, our more bullish thesis, right? But the reason I'm a bit more cautiously optimistic and I'm not, yay, we're going to hit new highs is that, first of all that's really changed is just the sentiment around the Fed. We haven't really had a huge data shift, either in growth or inflation, since the start of the year. Um, but perhaps more importantly, there's still a few overhangs, and that's um, if economic data becomes stronger than feared. Okay, because that is the risk, and that's the risk we said if data comes in too cold, where they price in recession, which I don't think will happen. But if data comes in too hot, it's negative. It'll embolden the Fed to hike rates more, perhaps go above this 5% level. And that is uncertainty. Okay. And uncertainty is actually is worse than bad news. Okay. Uncertainty is markets hate uncertainty more than they hate bad news. Okay. I think new highs come in when all uncertainty is removed from this market. But until you have a rally that could be threatened by just any um, overly hot economic report, sort of like we had a very strong jobs report that caused the market to sell off. The expectation was 100K US jobs, 500K got created. That caused the market to sell off. So that leads me to be a bit more cautious. Okay. Now, but I do think we'll trade through this 4,100 level. But what determines whether we mean revert back to it or whether we start trading at 4,300, right? So, how do things get better? How do things get bullish? So, obviously, okay, we have if CPI continues to drop, that's kind of a no brainer, okay? Ironically, if the labor market starts to deteriorate a bit, okay, and I don't mean to the point where we price in recession, but particularly if it rises modestly between 4 and 5%, okay. If it stays within anything above 5% starts to become bearish. But as long as inflation starts to rise a bit between 4 and 5%, I take that's the market actually wants to see that. Um, if the Fed sort of implies a 25 basis point hike in March, that's bullish. That's it. And then it sort of implies that the terminal rate won't rise above 5%. Okay. If the markets somehow start to price this in, this gets very bullish. Okay. And lastly, I think whether or not this happens or not, I think markets start to price in a bit higher EPS at this if the sentiment is so good. Let's keep it at 225, right? But I think that would rise. I think if we start to see this, okay, where labor market starts to rise start to get a bit weaker, but not concerningly weaker. Again, between 4 and 5% unemployment rate, and a Fed that is still basically kind of, telling us terminal rates won't rise above 5%. I think that starts to justify between 18 times and perhaps 18 and a half times multiple. Okay. That puts the S&P fair value at exactly almost 4,300. Okay. And by the way, these multiples are historical. Okay. Historically, the S&P on average is traded at 20 times trailing. Okay. This is forward, so future EPS. And there's just I encourage you to look at sort of study of this. I think historically 15 to 16 times has been a hard landing, uh, 14 times recession. And so it's just about understanding sort of these levels and where they come from. So a bit more weakness in the labor force in labor market will actually be taken as bullish. A Fed that hikes 25 basis points in March, market-based expectations that fall below 5% terminal rate, which is the rate the Fed will stop hiking at. I think that takes us to 18 to 8.5, 18.5 times multiple. Okay. And remember, as I said, this EPS, if these are the street lifts up their EPS, the street being the research firms and the banks, they move their target of what earnings will be based off the sentiment. So if sentiment rises, they'll increase their earnings targets. If this gets to around 230 on 18 times, that's around the same. So probably, oh yeah, we're at 18 times now. So sorry, 18 and a half times. Yeah. So at 18 and a half times, we're between 17 18 now. 18 and a half times. Okay, I'll just say 19. Sorry, I just won't get too granular. At a midpoint of 18 and a half times, we get 4,255, around 4,300, right? So I think these are the conditions we need to see in order to get there. Okay. And then the bearish scenario, well, it's pretty obvious. If inflation not just shows that it's stickier, but it's just choppier than normal, and it shows that it won't be just a smooth ride down, I think that's pretty obvious. But if um, if the labor market stays very tight, okay, and wages stay stubbornly high, if economic growth somehow rolls over, remember there is a possibility that economic growth rolls over while the labor market stays tight, because the labor market is usually the last to go, the last to weaken, right? I think that starts getting EPS estimates down, definitely below 225. But the most important thing is that multiples will reprice to around 15, 16 times. So this I won't do the math. This gets us to about 3,300 to 3,500 S&P, which sort of puts us into the range that we were. Um, in the summer. Okay. So that's just the bearish. Markets just open green. If we look at, you know, looks like we're defending this level. Okay. We're grinding up against yesterday's highs again. Looks like a pretty good setup for us to go. I think we're about actually fair valued. Given everything that we know, we're about fair valued. I do think things are going to get better, i.e., we're not going to enter the more bearish assumptions. I think will ebb and flow between bearish and bullish data points, but we sort of drift into more bullish news, hopefully, right? And I think that that justifies 4,300 a bit more. But point is, we're at fair value, and I think when markets are taken by optimism, they could they can push back, they can push past fair value, um, and uh, and start trading there. That's, I think, what's going to happen.
Oh, there's a question for you.
Yes,
WBDP is asking, can you briefly explain what rollover means here?
yes, no problem. So when I say roll over, uh, if you think about if you fall off your bed, you roll over the side of your bed and you fall down and hurt yourself. Now think about the economy. That's just the analogy there. So goes down, gets worse. Economic data rolls over. Um, yeah, weakens from here. So that's what I mean by there. Yeah. Anytime there's a term you're unclear about, feel free to ask. Yeah. Okay. So these are the key things to watch. Fed speak. Any Fed leadership that threatens rates, terminal rate above this key level right here, 5.13. And yeah, I would keep my eye on that. But I think now I want to talk about this no landing narrative here. So in so I had spoken about Goldilocks, how we're in Goldilocks right now. So as long as economic data is just right. Okay, so not too hot, not too cold. Uh, we get a soft landing. Okay, let's just fill this up because before I explain what no landing is. So soft landing, pretty obvious. The unemployment rate between 4 and 5%. That implies it rises modestly. Okay. Economic growth. It can slow down, right? But the key doesn't slow down as much as inflation. Okay. Um, if we have if core CPI keeps declining, perhaps if before first half 2023, if we get a reading below 5%, that would be huge. Um, Fed funds rate between the terminal Fed funds rate between these levels that we had spoken about. Oops, sorry, this is a four, right? Um, you know, this we rally to. This gets us to you know, mid to upper 4,000s. Okay, and here you want to be long growth. Okay, so that's the soft landing scenario that the markets are currently really excited for that might happen, right? Hard landing is always an option, but what's the other option that might happen that nobody speaks about? It's no landing, okay? So in terms of Goldilocks, in terms of my Goldilocks, what would we need to see for no landing? So again, Goldilocks is we need data to come in just right, okay? Because as long as data comes in just right, that means market pricing is correct. And if market pricing is correct, it means that the market's pricing of the stock market is correct. And that should fuel more risk on sentiment. But in a no landing scenario, okay, we have data that comes in too hot, okay? And this is why it's a no landing. It's weird because too hot is bad for stocks, but nobody's complaining on the economy, okay? Because the economy is still really strong. So if unemployment this year comes in very strong, continues to come in very strong, economic growth stays very strong. Inflation continues to go down. No one's saying anything happens to inflation. Inflation continues to stay down. Economic growth stays strong. Unemployment very strong. So you get this too hot Goldilocks scenario. Okay. I think what's going to happen, that's going to drive the Fed and market based pricing to imply a terminal rate above this 5.125% that the market's pricing. What's going to happen? This is going to be negative for stocks because the narrative is going to be don't fight the Fed. Okay. And I think the fair value range, if we get a no landing year, is 3,500 to 4,000. Okay. And so this is sort of the dark horse that no one's talking about. Okay. And again, I think growth would sell off, and you would be more better served in value industrial cyclicals. Okay. No point in even talking about the hard landing. I think we all know what's happening there. So it's really this overhang right now. I think the markets are oscillating between two narratives. Are we transitioning to soft landing where everything sort of comes in as planned the next few months, inflation decelerates a bit, unemployment comes in, and economic growth comes in at levels which still imply that the economy is good, but isn't extremely tight where the Fed scratches its head and goes, why are we taking our foot off the rate hikes now? Then that causes the Fed funds rate to go a bit higher. So the market is currently pricing this. The dark horse is that we get into a no landing scenario where, in Goldilocks terms, is we get too hot of data. Um, I think that causes a repricing. Okay, and um, so basically, if that's why, you know, I'm not I'm risk on right now, and I was risk on before. That's why I'm not saying these risk ons are gonna lead to new highs in the S&P. Okay? Because there's two things. The economy will still be at risk of a slowdown. Okay? Keep in mind we're late cycle. Okay? We're not late cycle, sorry. In terms of economic data, it hasn't rolled over, and that's still overhang risk. And you know, there's you're still in this you still have this overhang where you know, the risk sticks, and you have economic data which is too hot that um, threatens your soft landing narrative and turns it into a no landing. Again, no landing just prolongs the delay until we get to soft and hard landing. But what did I say? Markets hate uncertainty. They want to transition to a soft landing now because they can see it. That's the most bullish scenario. If you tell the markets today we're going to have no landing for another year, and then in a year we're going to redo this whole exercise of predicting whether we're going to soft land or hard land, the markets won't like that because now you've just increased the probability of a hard landing, right? Again, the most optimal scenario for the Fed is they hike, inflation goes down, and the Fed can stop before they kill the economy. The longer the Fed has to go, the increased probability that they'll commit an error and they'll go too far. Okay. So um, that is sort of where we're staying, where what we're at. Like that's sort of the briefing where we're at. And so um, to reiterate things, okay, we're currently trading between I think the S&P fair value is between 4100 4200. That again implies between 18 and 19 times multiple, okay? And I think that's, that's justified. But again, we're a bit overvalued because we have these overhangs waiting for us. That we could get economic data at any time. Like people who don't know, I think the market is starting to firm up its expectations that inflation is going down. I think the market's comfortable with that. What the market isn't comfortable with yet is labor market and growth. I mean, that was a huge surprise where we beat estimates. The estimate was 100,000 and we came in at 500,000 new jobs added. That just shows you the market really has no idea what it's pricing in terms of growth at any time that overhang exists. So, you know, I'm cautiously optimistic with tight stops, and that is in contrast to another scenario where I would just be like, um, this is what we're pricing in, but fair value is 4,400 or 4,500. No, I think fair value is between 4,100, 4,200, where we are now. But given that markets tend to, this is, we all know markets tend to oscillate above and below fair value. I think we go a bit higher just based off some euphoria, some optimism to 4,300. And then we reevaluate there. I want to see these conditions met at 4,300. So unemployment, economic growth, market-based Fed's fund pricing rate. If we hit, and we will hit 4,300, and then some of these things on our dashboard start to break or buckle, that could threaten the rally. And that takes us back to fair value or a bit below it. So um, that I hope to giving you like sort of a map in the simplest terms possible. That's sort of like if you're like a navigator, um, you know, what are you looking for? How calm are the waters? where do you need to sort of be, and when once you're there, what are you looking for, right? So um try to be as comprehensive as possible, and remember that remember yeah, just last thing, this is more for me, it's you know this sort of stuff, you're much better off being just a long-term buy and hold investor. I think this is more for educational purposes, and what sort of the pros look at in a very simplified way. I want to stress, like, for me to actually, if I were to actually sit here and give investment recommendations based off this is just a few hours, not an hour of research, like a week. Um, People monitor this stuff all day, every day, if they're actively managing risk. I think to be successful in the market, so that would be my ideal complete view. I don't think you need to do that to be successful in the market. I think, you know, dollar cost averaging strategies, um, accumulating, and taking advantage of the fact that you're not marked to market. Uh, you're not marked month to month. You can afford to buy when it's cheap and let it be cheap for a few more months. Um, I think that rings true. Just buy and hold quality. I think that's all you guys need to do to be successful uh, investing. But I just wanted to be clear. This is more on the trading side. Don't feel like you have to be monitoring all of this stuff to make money in the market. Um, I think that this is just for educational purposes. And I'm even going to tell you that if you wanted to make money off of this as a trader, even my research isn't enough, right? I think I'm putting this is more for educational purposes. I would be putting way more um, detail, making models, being in touch with like more granular level news flow, information flow. Um, you know, so just wanted to, but it doesn't hurt to be aware of all this stuff, which is why um, you guys are here learning about it. So yeah. Wait, did you have what did you want to add? Way to this lesson. Not sure if you were able to have most of it.
Yeah, no, not much to add. I mean, I haven't been paying as much attention to the market this last little while. There's a lot going on, but I think, yeah, I don't think like at a very high level anything has really changed in my view. In terms of this is a market that's rife with uncertainty, so
Hmm.
this is also why Otto is laying out all of these different scenarios. And when you're in a situation where you're unsure of where the potential direction is, because there's always this distribution of probabilities of outcomes, then this is like a useful framework to you know basically keep yourself your kind of thought structure or your analysis very structured. And
Hmm.
that's always very important as a investor or a trader. Like you need to be able to assess different types of outcomes. Um, a lot of many newcomers to the markets, they think, again, we always say this, they think markets is about going out there and predicting what's going to happen. Like, I think this is going to be what happens. I think the market is going to recover. I think the inflation is going to be high. I think inflation is going to be low. It doesn't really matter. What matters is what could happen,
Hmm.
right? It doesn't
Exactly.
matter what you think. um, the markets are going to do what they want to do. So for you, your job is to try to figure out what could happen, right? And you can still have a view. You can have a view to say, I still think this is the most likely outcome, but you have to understand what happens if your thesis does not unfold. What if
Hmm.
something else happens? And many times, something else ends up being the case. In those cases, how is the market going to be impacted, right? What is the market response? Where are prices likely to go? And only then can you make educated or informed decisions around what types of actions to take, right? So this now gets into risk management because if you understand how things can go wrong, then you have a plan, right? So if something goes against your goes against your expectations, and then you have a plan to be able to actually like take actions that could save you a lot of losses, and or pivot into something else that may be more reflective of how markets are behaving. So this is why this type of analysis is very important. You always need to think about what could happen that's different than your expectations, and only then are you able to manage risk properly and survive in the markets over the long term. So I hope we come across as like a broken record, because every single time we talk about this stuff, we always come back to risk management. But really, that's the entire that's the entire kind of skill set that you're developing when
Yeah.
you're in the markets, is how to manage risk properly, how to assess different probabilities, how to understand what the market is actually telling you, and then how do you actually come up with a structured approach to basically navigating the markets.
Yeah. No, perfectly said. Yeah. I guarantee if we gave everybody the same signals, right? Buy, sell, when to buy, when to sell, and nothing else. Everybody on this call, Way included, myself, and yeah, you were told nothing else than when to buy and when to sell. Sounds like we should all have the same returns, right? Well, I guarantee you that we would all have drastically different returns. Not in terms of a few percentage points, but probably to the point where some people might be negative and some people might be zero and some people might be making 30%, 40%. Why? Even if we have the exact same signals, even if we were on the right side of the market every single time. Why? Because it's not about signals, it's about your risk management, how you trade around it. You can have the same signals, but inevitably some of the signals that I give you or somebody are going to be wrong. What happens in those wrong scenarios? The people making out like a bandit with 30, 40%, the times that they were wrong, they were like, you know, this is giving me a buy signal, but okay, I'm going to put a really tight stop. I'm not going to position size a lot into it because it's not really sitting well with me. And then, whereas somebody that's in the negative is probably betting the same amount every single time in and out, or they're on the wrong side of the trade, or they're over levering on the wrong trades. So the alpha, as Wei puts it, doesn't come from the uh, the signals, comes from the position sizing. Your skew on winning trades to losing trades, right? That sort of how much conviction you have in the right trades. Then that comes down to being a good trader, right? If the best traders are always high conviction at the right moves, right? So that is the thinking we want to convert you guys to. And that's very drastic from all your other TikTok investors and YouTube investors, completely focused on entry points and whatnot. It's complete hot garbage, right? Um, so that is the view. So just to recap, okay, where we are in the markets, because I'm sure you guys find it interesting. This is what we're pricing in. Uh, Based off of that, S&P fair value is, we determined 4,100. Is that overvalued? Is that undervalued? Is that a steal? We think that's fairly valued to slightly overvalued. Okay. Probably slightly overvalued. Okay. Why? Because there's still uncertainty, okay, in the markets. Any hot economic data report or labor market report can buck this, okay, and cause the Fed terminal rate expectations to go way past 5%, okay. But given things are improving, okay, given we are getting comfortable around inflation settling down, given we are getting comfortable that Powell isn't pushing back on dovish money flows, right? So that he's starting to probably get the market to price in a pause, right? You know, based off that, we could justify an 18 to 19 times multiple, even though we're fairly valued or slightly overvalued, right? I can see this being the case. I could see the market getting ahead of itself like it always does and pricing it 18 to 19 times. That makes us trade to 4,300. Okay, so 4,250, 4,280. That takes us up there. Probably some, optimism around earnings, whatnot, definitely won't hurt. 4,300. And that is very in line with where we view our technicals. Okay. I think we're very bullish on technicals wise right now. I think, and we have been bullish. We've been on the right side of it. Uh, Waited for some confirmation and we got it. So this ascending triangle, we break out, we get to 4,300 level. Okay. Now, what do we need to see when we get there? Well, we laid it out, right? We want to see this. We want to see a labor market that isn't too hot. Unemployment rate, happy to have it drift up into the 4 to 5% range. Okay. Want to see I want to see 25 basis points in March set in stone. Okay. And market based expectations of the terminal rate that don't um, significantly rise above 5%. I think if we get these two outcomes right here, okay, if we get these two outcomes right here, fair value becomes 4,300. Okay. Again, though, there's uncertainty. That path there is marred with uncertainty. So be careful. And again, it's all about you can have this game plan. I could give everybody this game plan. Okay. And we'll all have, and signals and whatnot will all have different trading results because it's about your risk management. So this is the state of the markets. And with that, I'll leave you guys off. If there's any questions in the chat that I don't think I missed, uh, don't think I missed any. So you guys know how to reach me, DMs, Discord, Twitter. So if you have any further questions, but for that, um, myself and Wei will sign off. Thanks for joining us, everyone.
Thanks, everyone.